Welcome. Thanks for joining our first one of 2024. With me today is Charlie Jones, CEO of Flowco.
Good to see you, Matt.
You too.
Thanks for having me back.
Oh, my
I said last year, this is like being on the Fallon of the oil patch. I feel like I'm a second-time guest on Fallon.
Well, you did such a good job last time and brought some good content.
It was a lot of fun. We'll try to make it fun today, too.
That's what I'm looking forward to. I'm also hoping to knock the dust off a little bit. It's been a few months since we've been up here, and we've been fiddling around a little too much, but that's okay. It's part of it. By the next one, we should be experts at running the audio visual. But big thing, guys. Thank you for joining. First one of the year. Like we've done in the past, and I kind of like the trend of it is first one start off with hopefully a lot of optimistic views on the market. Get everybody up to speed on what's going on. And then from here, every future session that we'll do throughout the year will be very technical, very focused on a specific topic, such as gas lift troubleshooting or gas lift optimization or plunger lift calculations for implementing plunger lift and things like that. But like to get us all kind of warmed up for the year. Of course, great feedback last year having you on. To really kind of talk about expectations. And one of the big things I want to do today, if you're willing, is do a look back at kind of the predictions, what the trends were last year.
I absolutely want to do that. I think it's going to be fun.
Yeah.
I've got a few notes here on some of that, and I'll look for it. You know, Matt, also, this is a great time to do this. We had a board meeting just yesterday at Flowco. And so I'm kind of hot off the press with kind of what our board and people that speak with our board are also thinking. So it'll be fun to talk about it.
All right.
Company's doing great, though, by the way.
Good.
Great.
So raises for everybody this year?
I can't promise that we'll be able to keep up with the rate of inflation, though. We'll see. It's been tough grind the last couple of years.
I know it. I think everybody has felt that. So yeah, big thing, guys. While we're going through all this, we will record this one. We'll post it. Oh, we're muted. Okay.
Oh, great.
Oh,
Hear that? I can hear.
Maybe it's just that.
okay. Sorry, guys. We're having a little technical difficulty.
Okay.
It's just Scott.
If you can hear us, then they can hear us.
It's just Scott.
Okay. All right. Like I said, guys, first one of the year. Trying to get all the dust knocked off.
Hey, it's about the recovery, Matt.
Oh yeah.
All right. It's all about the recovery.
That's
Good
right.
recovery.
Yeah. Thank you. So a couple things before we get started. We will record this. We'll have it posted on the Flowco website. So if anybody wasn't able to join, if you got to get off early, anything like that, we'll make sure to record that so you guys have access to it. Charlie, you know, I know I put a couple slides together. I know you have a lot of content. We try to keep this capped to right about an hour. Guys, if you have any questions, feel free to throw them up in the chat. While we're going through the discussion, we can stop and answer them. We can also save some of the questions at the end and do a little Q&A session.
I hope we get some good questions.
Yeah, me too. I'm looking forward to it. And so, yeah, we can do a little Q&A at the end and wrap it up and let everybody get back to work. So with that, Charlie, if you're good, I'll throw presentation up so we can talk about a couple things. And
yeah, we probably should just try to step through what you've got there. I'll have a couple comments, but at the end, we'll circle back.
Perfect.
That's okay.
Yes, sir.
You can level set, walk us through the deck you've got there.
Yeah, that sounds great. And so, guys, like we said, really like to get an expert in, such as Charlie Jones, kind of go through 2024 expected trends, look at last year in terms of some of the large kind of market KPIs that, in my opinion, might not be relevant to a very specific piece of the industry, but tend to be pretty relevant to the industry as a whole. And so we'll go through that and, of course, get your insight on everything and really just make it a a good discussion about what we're seeing. Of course, if you guys have to get off or anything like that and want to come back and watch it, we'll post that up on the Flowco website. So with that, Charlie, some of the stuff that I wanted to do, especially do a look back to last year and last few years, is run some overall trends. And, you know, of course, I think now what I'm starting to see, at least what I like to do, is use COVID as like the base.
Yeah.
Anytime I'm doing trending now, it's like revert back to COVID and use that as my base date. So of course that infamous 2020, and we get to see some interesting trends.
You know, Matt, right on that right there, I want to just stop and make a comment that the data that I've looked at and that I've been privy to see, and it's readily available in the public, is you see across not just our industry, but across all industries, this big spike, you know, this romp, if you will, and kind of a rebound post-COVID. But if you look at the longer term, like 10-year trend, most businesses never lost a beat. We came back down, but we bounced back, not to where we were, but where we would have been had COVID not happened. So that kind of trend has continued, even though we deviated. We didn't just dump back and tag on. Where, you know, the trend line is very strong across everything in our space.
Yes, sir. That's interesting. And, you know, I'll use this from a production term. It's flush production, right? Is when you look at a lot of production trends, you shut a well in for a period of time. And then when you bring it back on, it doesn't come back to previous shut-in production, right? It comes back to that flush production when a lot of times the goal or what ends up happening is that additional production makes up for that gap of lost production, and in this case, activity for us. So that's interesting. Charlie, one of the big things I want to talk about today too is the M&A activity. It pretty much since what, 21, 22, it has been
game on.
Yes, sir. And very specific. What I noticed is really two markets that are being consolidated incredibly. Permian, Delaware Basin out in West Texas and New Mexico, and then the Marcellus Utica gas play up in the Northeast. So want to bring up a couple big M&A activities. There was a couple really big ones there towards the end of 2023, and I expect probably more going into this year.
So. Yes, it's all about adding acreage for quality rock. You know, the guys that are getting the good rock are getting the premium for what they're selling. So.
Yes, sir. So great. Well, with that, let's dig into some of these graphs and definitely get.
Let me guess, you probably have a rig count graph.
Yeah, I do. And I have a rig count with a oil price graph.
There you go.
and kind of going back to, you know, what we talked about, right, is there's that big 2020 drop and, you know, everything from rig count to the commodity prices and general activity. But, you know, we get to see that pretty healthy return in a relatively short period of time, what, about 2 years? And like you said, kind of back up to that, you know, pre-COVID rig count and activity. One thing that I did notice, and we don't have it on a trend here, is if we did a look back past this point in 2020, rig count still lower than it was, but the number of wells completed and brought online is greater than it was, you know, say in like mid to late 19, which is interesting to see just from a efficiency standpoint, right? As the rigs are getting better, the frac crews are getting better at you know, doing more with less, which tends to be
that's what oil service has always done, is we add values for the client. And so all this efficiency that we're seeing today with this, you know, lower net average rig count. You know, I come from an era when below 1,000 rigs is considered horrible.
Oh, no kidding.
Yeah. And so I think the rig count in the Permian is running in the low 300s-ish right now.
Yes, sir.
And you look at that total number there, and you start to understand that when you think about the production and where it's coming from domestically and what the rig count is in the Permian as a percentage of that total, it really highlights how efficient as an industry we've gotten with the whole cycle, you know, of getting a well drilled and online and into production. It's a phenomenal story, really. Now, Wall Street should be talking about it. We'll get to why they're not in a minute, but it's a continued source of frustration that we don't get recognized by our nation for what we contribute to the nation.
Yeah, you're exactly right. And, one of the things that I guess was released earlier this week was the moratorium on new exports of natural gas for LNG. And I was reading a couple articles about that, and that's what they discuss is that, the efficiency to be able to put out natural gas at the volumes that we're doing and the cost point that we're doing, that it makes sense to get that natural gas out to the world at a relatively inexpensive, competitive price, even with the additional cost of LNG. So yeah, pretty interesting. So I like this one. There's, again, maybe not completely relevant to if you're a chemical vendor or something very specific, but I find that it's a helpful KPI. At least from the industry as a whole, understanding the health. And of course, I always like to look back at those days.
You've got some slides coming up that'll tie back to this, but I think the thing to kind of keep in the back of your mind is that oil price. There's a lot of external influences on that oil price that make it decouple in some ways from the domestic rig count, for sure. We'll talk about that too. I've got some comments later.
Yes, sir. Yeah, and that's a good point because historically, I guess you always would try to couple those two together
in some way, lead lag or whatever. But look at that chart. I mean, it's kind of decoupled, isn't it?
Yes, sir. It sure is. And maybe the next slide will show this as well. One of my favorite ones, duct count. So drilled but uncompleted wells, and really what we're seeing from the market, where those ducts are occurring. And really what operators are doing with them. And, this piece was pretty neat to see. Of course, I guess if we could overlay rig count and duct count, we could kind of see the inverse of those two, right? Is that
the drillers might disagree with you on that. Yeah. Neat to see. But,
yeah, that's true.
But this is a capital deployment decision that's creating this kind of inverse effect that you see. And I will come back to this later for sure. This is one slide, my favorite slide in the whole deck right here. There's a lot to talk about, but we'll divert if we go there now. Let's come back to it.
Yeah, definitely. So we'll save this one. We'll definitely come back, but kind of shows you guys the trend of those duct counts month over month versus oil price as well. So perfect. Well, yeah, we'll make sure to come back to this one, Charlie. With that, I want to get into some M&A discussion. So, the last couple years of tracking mergers and acquisitions, it's been very interesting to see there's been a couple shockers where like, oh, well, I didn't expect that, kind of the Oxy and Anadarko merger, I guess, the WPX and Devon, merger of equals and things like that. But one continuous trend that I've noticed the last few years has been the consolidation of the Permian Delaware.
Oh, yeah.
And of course, I shouldn't be shocked by it, but it has been interesting to see that. And of course, to me, it seems like that M&A activity just keeps getting bigger and bigger and bigger as time goes on. Last year, we saw a really heavy M&A activity in the Eagle Ford. So far, it's quieted down the last few months, but there's still, room for consolidation down in the Eagle Ford, where we've seen it almost continuously year over year over year has been primarily in that Permian Delaware Basin, Texas and New Mexico, and then also in the gas markets of the Haynesville and Marcellus Utica. The latest one for the gas market was the Chesapeake Swin acquisition. I think I read something that Chesapeake was the most prolific driller and producer in the Haynesville, and Swin was the number one in the Marcellus. So it's pretty interesting to see to tie those two together and basically gain Chesapeake access to those two markets. But with that, let's get let's get a couple.
Let's look at some acreage.
So one of the first ones I had put together was probably the biggest one in late 2023.
Big deal.
Should go through this summer, I believe. with ExxonMobil and Pioneer Natural Resources. So adding over 800,000 net acres. You can see when we look at kind of that overlap, where Pioneer was real strong, and of course where Exxon or XTO was strong, and man, it just really locks up that core kind of tier 1 acreage that Pioneer held on to.
And this is, Exxon announced years ago they were going to be making some big bets in the shale, and here we go. It's amazing. It's amazing.
And this merger came on the heels of the Denbury acquisition that Exxon made a few months prior to that, which I found the Denbury one was pretty interesting because most of the Denbury assets were old Exxon assets to begin with. That Exxon had
Come full circle.
Yes, sir. Yeah.
We haven't seen that before in the industry, have we?
No, of course not.
Jeez.
Yeah. So yeah, I think this is probably the biggest one, right?
Oh yeah.
That's going to give Exxon a huge hold in the Permian. Hopefully, they're able to carry over a lot of the technology personnel from the Pioneer side to keep that going.
Yeah. Thing to remember here is, it's like you can eat an apple one bite at a time, but you can only swallow so much. And so Exxon's a big company, but you've acquired this, now you've got to integrate it. And so how long is the timeout going to be before they consider making another move? Or do they make another move, right? And we're seeing a big resurgence internationally in deep water offshore. So it's going to be interesting to see where they start to deploy their capital in 2 to 5 years.
I see.
Having made these moves.
Yeah, that makes sense. Well, and that makes me wonder about, I don't have it on here, but the Chevron Hess acquisition, which from what I understood, gave them access to a lot more of the international and deep water
assets.
Yeah. Yep. So it did also open them up to areas that Chevron hasn't typically operated in, such as like Bakken, which you can maybe guess or assume that they might divest some of those onshore assets that are kind of not their core business, right?
Sometimes you got to buy the burger the way it comes, but you might not want the lettuce or tomatoes. So we'll see. We'll see. Yeah. It's just good that there's deals happening. People can argue that this consolidation may be bad for the industry, but I think net average, we've still got to be the low cost producer. There are a lot of people around the world that would love to be in this market. So the more we can produce here locally, does a lot of things for our country as well as the economics of it. So this is just natural, acquisition, movement, and validation of what began in the shale years ago. So.
Yes, sir. Well, and one thing that I see from it is potential for like stabilization of commodity prices.
Sure.
At least like WTI, right? Is that rather than having 200 or 300 PE-backed companies, you have 50, mix of public and private, really controlling their operations and their production and things like that. Here's another one, back to like what you mentioned, Oxy made the Anadarko acquisition a few years back, gave them a big holding there.
Do you remember how contentious that was?
Yeah,
that was a big one to swallow back then for a lot of people. So and these things are becoming easier for people to digest, is what I'm saying.
Yes, sir. Well, and I mean, I outside looking in, it seems like Oxy kind of proved the naysayers wrong on that one, as they did a good job and stock prices are back up. And
they're doing a great job.
Yeah. And so this is a neat one too, just some additional bolt-on acquisition, a little smaller, of course, about 100,000 net acres, but took that Crown Quest Lime Rock merger from a few years back and bolted that on to the Oxy. So gives Oxy a little larger footprint, adds some good acreage there, both in the Midland Basin, primarily is where this acquisition puts them at. And one thing that I find neat is the Permian side, the Midland Basin side, has been locked up, I guess, over the last few years. So a lot of the new exploration work has been pushing further west into the Texas, Delaware, into the New Mexico, Delaware. But now you're starting to see some of this consolidation to come back to that Midland Permian Basin side. Yep, that's a good one. Have to keep watching Oxy as they continue to consolidate out there. I mentioned Chevron, but more so from the PDC energy acquisition, primarily because this one, from an onshore standpoint, was a very direct bolt on to their existing activity. Hess was definitely a big one for Chevron, but it seemed to be more of their international, their offshore market, not specific to like what we're talking about today with onshore. But the Chevron acquiring PDC, that one I found was interesting because it increased their holding in Colorado for the DJ Basin, and it also gained them some access to add to their Permian assets as well.
It's going to be interesting to watch as these majors get more and more embedded in the shale plays. What happens with the deployment of new technology to, make these assets worth even more.
And you see that now, and that's been one nice thing about operating in the Permian Delaware is there's always advancements in technology and different applications. And, in our part, it's going to be primarily plunger lift and gas lift, right? But they tend to be slow and very sporadic. One thing we're noticing now is a combination, like you mentioned, the operators and also the benefit of being in the Permian Delaware Basin is that technology advancement is increasing, and the utilization of it from different operators is beginning to widen quite a bit. Meaning that if we have a high pressure gas, for example, that's a pretty common artificial lift method in most basins, but primarily Permian Delaware. Whereas beforehand, you might try it here or there kind of sporadically, but not really get the buy-in that you see across the board like we're seeing in the Permian Delaware. Let's see, what else do we have, Charlie? This one I find really interesting. I've started to dig a lot more into Permian resources.
Everybody's talking about them right now. Hottest stock there is. Yeah, everybody's talking about them. And it's great.
It really is. I mean, they're kind of a sleeper company that
have been.
Yes, not anymore.
They'll be on Kramer. If they haven't been on Kramer lately, then we'll see.
Yes, sir. But Permian Resources has consolidated quite a bit. It helped with Earthstone's consolidation of Titus and a few other operators. But they're becoming a really big player out in the Permian, or at least publicly they're becoming a big player. They, not to downgrade that they haven't been, but people are starting to notice what they're doing out there. So I wanted to make sure to include this one with the acquisition of Earthstone into that group. And so you can see they have pretty wide holding, again, all the way from the Midland Permian side out to your Texas, Delaware, up to your kind of sweet spot, that Lee Eddy County, New Mexico, Delaware. So that's one I've watched quite a bit now, as Permian Resources becoming my new favorite oil and gas company to watch. A couple other little ones, again, from that Permian side. Civitas. Civitas is somebody that's new to the Permian Basin over the last couple of years. They did a really good job of consolidating the DJ Basin a few years back. Acquired 5 or 6 different oil and gas companies, and really consolidated that DJ stuff up there in northern Colorado. But they've made 3 or 4 acquisitions down into the Permian Delaware Basin. And again, they're becoming a pretty big player both in the DJ and Delaware Basin. I could see that being like another Chevron acquisition or something like that to kind of add that bolt on to both of those 2 basins. Oventive, same thing. Multiple sellers they've picked up. Matador Resources picked up Advanced Energy Partners, and Vital, which used to be Laredo Petroleum, very similar. They've picked up Henry, which is, legacy Permian Midland operator, as well as a few others the last couple of years. So again, Vital, definitely watching those guys kind of becoming a additional player with the add-ons that they've made. And Charlie, one last thing I want to talk about from the gas market standpoint is that Chesapeake Southwest Energy acquisition. So that will make them one of the largest natural gas companies in the U.S., adding both the Haynesville and the Marcellus gas plays with both operators operate in, consolidating that together. So my thinking on this one is, who is EQT going to purchase next in the Marcellus area? So
are you aware? Did you see the letter that the CEO of EQT sent in protest of the restrictions being placed on LNG?
No, I didn't.
I stumbled on it last night, and I think he sent it in the last month or so. I suggest everybody don't go online and read it. It's out there. It's pretty good case that the gentleman made. Appreciate him doing it.
Yeah, I'll have to look that up. That sounds good. But yeah, Charlie, just a couple updates that I had. Would you like us to jump back to the?
Yeah. Before we do that, I wanted to take a minute here and just kind of do an update on what we talked about last year with regard to where we are in this energy transition, right? And then also take a minute to talk about our industry and what the energy transition and what that's doing to affect the transition that we're seeing here in our industry, right? And I had a little fun doing this last year. I hope you'll bear with me.
Yeah,
you'll find this. So I would frame the situation last year with regard to the energy transition was, we were sitting right here at this table and we were looking at this transition, and the consensus was that this thing is large, it's not going away, right? But it's very complicated, and it's actually really scary to all of us about what does this mean? Not just people in the industry, but people outside the industry. They're hearing all these different things, and it involves science and technology that they may not understand. Like you may not have to charge this car, and how long does it take, and why. There was just this big kind of misunderstood, scary part to the energy transition, right? And because of that, it also became highly political. And in fact, a year ago, and I checked this, you can fact check me if you want, but there were a lot of companies that were taking the energy transition and positing it as a corporate purpose. Instead of, we're in the business of doing X, we're really no longer in the business of doing X. What we're in the business of is promoting this energy transition. So it was almost as if they're virtue signaling to help their company that they've got the right mindset with respect to energy transition. It was very political. It's still political, but it was just extremely political. The issue, though, that was happening a year ago was investors were seeing it as very difficult to invest in and risky to invest in because of all these variables. There wasn't really a full, I would say, comfortable understanding like many people have of our industry today. We've got a pretty mature industry they can look at and make their bets, if you will, in the market on. But this transition also looked to be very, very expensive. And the goals that were being set globally to affect a transition by different countries, by different governments, we were sitting here a year ago and, man, these things they really, really look aggressive, and a lot of them look unrealistic. We're going to be using X amount of coal somewhere out, and you're kind of looking at that going, well, how's that going to happen? It all seemed aspirational, scary, complicated, probably expensive, et cetera, et cetera. But in the end, the comfort we had was that we live in a capitalistic society here, and capitalism generally figures it out. Right. And the most efficient use of the dollar actually happens at the end. We can really screw up as we go down that path, but in the end, so we were kind of counting on the industry to let consumers bail us out. Okay, so some of the fun facts around that were in 75, and I said this last year, 95% of our energy for electricity came from fossil fuels. Almost 50 years later, 49 years later, 82% come from fossil fuels. And we are expected to drop that down to 73% by 2040. So we're sitting here in 2024, and we're saying by 2040, we're going to move that to 73%.
Mm-hmm.
But fossil fuel demand hasn't peaked yet. In fact, last year, it went up. So in spite of all this, it went up.
The demand of fossil
demand
fuel
for fossil fuel increased. Yeah, and overall energy demand increased last year. This doesn't come without, there's always balances, checks and balances. So coal consumption over this period is expected to decline, but the decline we're going to see in coal, we're going to need it. The rough math is between 2.5 and 3 times the amount of natural gas to offset the projected decrease in coal. So all these expectations were kind of getting set, and the reality was, how's this going to happen, right? So wind and solar last year represented about 8% of our electric supply globally, and it needs to be 70%. How's that going to happen? Okay, here. That was where we were thinking last year. We're all a year older. We've got more experience. I've driven through Sweetwater, Texas. I've seen all the thousands and thousands of blades stacked in a pile because, if you take a boat that's fiberglass and leave it out in the sunlight for 5 years, go look at what kind of boat you got left.
Right.
Fiberglass.
Yeah, it starts to degrade.
Windmill blades kind of do the same thing. So we don't talk about it. And then the one point I made last year that is still in effect, that less or about 1/100% of the wind and solar that we generate today actually gets stored. So you've got nighttime and you got times of the wind and blow. So there's all these questions are out there. So what's the current situation? It's still large. It's still a complicated problem, but it's less scary because we're getting a little more comfortable with all this as a nation, right? It does remain political, but it's more muted, okay? And we're kind of becoming normalized in our perspective with respect to this energy transition. But the hard costs of ESG initiatives and electric vehicles are also being better understood. Many green initiatives that big companies that were virtue signaling put out there are getting pulled back. I'll give you an example. Got some?
No, go ahead. I agree with you on that.
So Ford announced a few months ago they were cutting their production of the F-150 Lightning by 50% because of a lack of demand, and they're piling up in dealer lots. This is driven by economics, right? And they also announced kind of pausing their planned $3.5 billion battery plant that they were going to build. So all this is kind of getting back to the market, is starting, to rationalize. So it's amazing to me that within just a year, we're starting to get back to what I call a new normal. Okay, so I'm going to switch now to the industry, what we're talking about here. So those things are kind of global and those related to this energy transition that was been such a hot topic. Last year, when we looked at leverage, and this is the key thing that's driving a lot of these deals, okay, leverage got as high as about 6 times. So what we're saying here is that the amount of debt that everyone in our industry, E&P companies, if you spread it across, they were levered to about 6 times their profits. Okay, so your annual profits times 6 was how much leverage they had. And that fell into last year. We were at about 2.8 times leverage. Guess what's happened in the following year? It's down under 1.
Really?
Yeah. So across the industry, everyone is paying down debt. And what's driving that pay down in debt? It's because, and we mentioned this last year, but it's really, really taken hold this year, is investors are absolutely wanting to see cash returns for their investment. It used to be, if you wanted to buy a stock in our space and you wanted to get one that pay a dividend, you'd buy ExxonMobil. They've already paid a dividend. But if you were investing in a company like ours or someone else's, it was generally a growth investment. You weren't expecting to get a dividend. Well, today, many much smaller companies that are public and able to pay dividends that are, you can see, that has become the norm. So this whole idea of, taking your profits and reinvesting them in growth is being offset now, and it's changed dramatically into trying to mute the growth, i.e. spend the capital on just growing your business, shareholders are wanting that return first. And what that's doing is it's making our industry more attractive to investment. That compression, you know, is starting to happen. So could you jump back to that? I think it was slide 4 with the duck wells. Let's talk about that for a minute.
Yeah, I sure can. And, you know, while I'm doing that, when you mention that, I think of the capital discipline discussion that operators started to have.
Yep.
In basically around COVID time, right? And I'll admit I was a little pessimistic in terms of expecting that to last.
Right.
Usually I figured it would last until oil prices.
The latest new trend. Right?
Exactly. And
but it's here.
It is.
It is duck.
And it's, you know, especially, and not to hijack what you're talking
about.
No. Capital discipline at this. When oil broke that $100 mark, it was, I figured it would just go out the window at that point, and it really hasn't. And so I've been impressed with that across the industry.
Yeah, so if you kind of bifurcate that slide into a left hand 50% and a right hand 50%, and where those two cross, right? Let's talk about that. Let me just interpret what I'm seeing. So if oil price is in green and you've got this pent up supply, which you see in the duck well count on the left side, what's going on here? What's going on, I think, is as oil price was rising, there's visibility in rising. Because we're trying to begin to exert capital discipline, let's deplete our existing asset, meaning we got these ducks sitting over here. Let's not go drill them up, right? So the oil price is increase. And then you would think at some point with that high price you're talking to, you would start to see some wells go into inventory, but we're not. We didn't in the center of the screen there. Now look at what's going on going forward, right? The duck count is continuing. Actually, it's been dipping recently, yet the oil price is not a bad price. And it's driven by this entire capital decision making with regard to, and this goes back to the service businesses. If you run a manufacturing company, you'd love to get to where you're just in time. You would love to get to the point where you're basically, once you get an order, you'd love to be able to produce it in a day and get it out the door, right? And keep your inventory down. Look at that chart. Do you think that's going on here? Think how quickly we can bring wells online from existing inventory. For example, the mergers you were just talking about, what are you getting? Existing inventory, right? So there's a confidence. I read this as there's a confidence for all the companies like ours that we can quickly and with great rigor bring on a known production level with a much lower risk, which means no different than I mentioned the rig count. I'm used to it being under 1,000 being a bad number. We're probably seeing a new paradigm in what's going to happen with duck wells.
Where you're thinking they're going to stay low for longer and allow those operators just pull that inventory essentially when they need it a lot quicker time frame.
Yeah, because if you can do it with confidence, why would you run your duck well count up, right? And if my experience is that when the duck wells increased, the theory was, and wells took a lot longer to drill and complete. And so it was an opportunistic move when rig rates, day rates were low. Let's affect those rates and build up an inventory. So therefore, when the price is high and the rig rates are high, we don't have to participate in that. We can draw on this. Well, that may now change because it has changed because we're now seeing the ability, the confidence, if you will, of all these operators that they can reliably with good known acreage, bring this acreage online and get the production rates and volumes that they're looking for. And in essence, and a lot of investors talk about it this way, and they were talking about it 10 years ago, but they're now saying in 2024, this is absolutely 100% sure. This is the year that the shale is now in manufacturing mode. It is really all about production efficiency, what we do, right? It's all about production efficiency. And this, I think, is a big demonstration of that.
Oh, I see.
So it could be bad for some, but life changes. But in the end, this having confidence is a big deal. And I want to make one more point. I've got a note here. I want to read it. There is a website I'd like to refer the listeners to if you've got time.
Yeah, we can throw it up in the chat as well.
Yeah. Okay. Yeah. Just it's called Switch On, one word, SWITCH on.org. And what that is, it's a site that tries to be relatively objective about a lot of things around energy. And Scott Tinker, who is I think he was the founder of Switch.on. I was introduced to his stuff a few years ago. They've got a website where you can go in and you can look at they posit different problems, and they try to put up facts as well as they can that are very neutral. And one of the things that circles back that I picked up on something Scott was saying up there was, we've got wars happening around the world. A year ago we had Ukraine, right? Now we've got this issue with Israel. We've got this issue now with terrorists attacking U.S. assets in the Middle East. We've got a lot of, upset going on around the world. And I think what's happening in the end, and they mention this at switchon.org, is that in a weird way, unfortunately, war and disruption and uncertainty is driving a linkage that existed before. And that linkage works like this, and it ties back to the energy transition. That if you have a secure source of energy, you have energy security. Having energy security drives economic security, right?
Right.
So if you have energy security, it gives you comfort and you get economic security from it. We're producing and have been for many months, over 13 million barrels a day out of the Permian, and primarily out of the Permian. And that is giving us economic security. Once we get economic security, it enables you to think about environmental security. So the loop is starting to be connected between what I'll call the green ESG, efforts, right? It's starting to see full circle that we need fossil fuels. We're going to need fossil fuels for a long time. This whole transition is extremely expensive, especially if a government pushes it on you. Right. So we're starting to see a normalization. That circle's kind of tightening up, and it's kind of looping back. And you're seeing these acquisitions, and it's all about the quality of the rock and being able to produce it reliably.
Yeah,
so
that makes sense.
It's just kind of my little summary of what I see in my little world.
No, and that's great feedback. And I have a question about the ESG piece, because you're right. Like in, say, 2022, that was becoming a very popular focus point from a lot of our operators, a lot of the operators in the US, to ESG audits, to tracking certain things that would affect ESG. But then it kind of quietly went away for the most part. At least you don't hear about it as often. So do you think with that full circle, is ESG always going to be a piece, but maybe it's just morphing or changing in terms of its focus? Or is it just becoming a smaller, sticking point to that full transition?
When I first heard the words ESG, I didn't understand what was going on. And my reaction was, we're already doing that. We're just not, capturing it and calling it these words. We're all humans. Nobody wants to pollute the earth.
Right.
Everybody wants to have everybody have equal right to, given a chance in the United States to succeed. And everybody wants, to support people in need through social activities. We've been doing these things. So I saw it as just someone's putting a label on it. The issue I saw was it then became political, and it became the thing to say, and people signaled their virtue of their company, as I mentioned earlier, through their ESG programs. I'm just telling you what I've read. I haven't done this, but there's lots of places you can go where there are firms out there that look at quarterly calls that are documented. They're written down, they're logged, and you can do a word search for the word ESG, for example, in one of the largest in the world oil companies' announcements, and compare the number of times that those three letters come together. And it's dramatically down from where it was 2 years ago.
Really?
Check it out.
Yeah.
And the point is, it doesn't mean it's less important. It's just the market is now rationalizing that we need returns before we do all these other things. Those are great, but we can't do those things if we don't get our returns. And that's rationalization. And that's what I'm excited about. I will close what I'm trying to say with this. This year for us in this industry is a test by Wall Street. There was great capital discipline. You saw it on that duck chart, right?
Yes, we have.
And Wall Street was looking at our customers, the E&Ps, Are they going to exert capital discipline? They did. You can see it.
Mhm.
But in the oil service space that we operate in, that we live in at Flowco, and many people on this call, Wall Street has always felt that we got there first. We were squeezing our capital discipline before the operators.
As a service company.
As a service company. As a service
yeah.
company. So now what I'm hearing is that Wall Street has really got us on point. This year they're going to watch us, and if we do a good job, finally, we might start to see some real money come back into our sector from Wall Street.
Mhm.
And that's been the real problem, is as a percent of the S&P, we have fallen to be just almost nothing is an energy industry as a percentage of the S&P. And so the thing to watch as we go through this year is let's watch and see of the S&P what the energy service or the energy companies within there, is it growing back to be, from, I don't know the numbers today, I should watch it or known it, I don't know, 1 to 3% or something, but is it going to get back to 5% or something?
Yes, sir.
So we'll see.
And that's a good point. And actually, I wrote something down earlier to ask you about that. When we look at our M&A activity, we're primarily focused on the operators, and it's these big dollar acquisitions. They're either all stock, or last year there was a lot of all cash deals. This year it seems to be a mix, or primarily all stock. But one of the things that we're not really seeing is the service company merger and acquisition. Maybe you see it on the drilling side. I think there's a big drilling acquisition late last year, but you don't see it at the prevalence as you see the operator side, and maybe that's what it is, like you already mentioned with the stock market. But I was curious about what your thoughts are.
When you look at the large, and I'm not talking about the big 3 or 4, I'm talking about the larger service companies below the big 4. They are all struggling to generate and pay cash returns to their shareholders. And so why would you give up your cash to make an acquisition for something that's not generating more cash than you are? It isn't something that they're prone to do. So if you look at the larger oil service companies that are not part of the big 4, that have historically been very active in M&A, they're not doing it for 2 reasons. They're not generating the cash that they'd like to. Sellers are not willing to sell for anything but cash, because they don't want to take equity in something that's not necessarily generating cash. We've kind of got this stalemate going on. And pay attention to private companies and mergers of private companies this year, because they can make decisions independent of the public market. There are investors, don't forget, there are investors in those private companies, so they have their own attitudes about this, and it sometimes is in alignment with the public market. But just pay attention to that. So the ones that make the news are the publicly traded ones when they do something. But even the publicly traded ones I'm aware of that have made some deals, it's not a headline print. They have to announce it, but it's like buried in.
Yes, and that's what I've noticed too. And they're relatively small deals in terms of the big 4 making deals. Is that it's a little bolt-on business. It's not one of them trying to acquire another one from the top 4.
But as Wall Street money starts to come back in, it's going to be changing. I think the outlook is really good for our industry, especially in the space that we sit in. Wouldn't want to be a driller right now. No offense to the drillers on the call. It's tough. That's where I came from. That's a tough place to be right now.
No, that's great insight, and I agree with you. Looking forward to 2024. And tell you the truth, we've been looking forward to every year. Heck, even January 2020, I thought was going to be a great year, and it did. Towards the end of the year, recover, and from our side of things, it's keeping up with that activity. It's making sure that we're in line with the operators in terms of what their expectations are, is that we're getting the production out, but we're not getting the production out at a wasted cost, that we're, applying that capital to where it needs to be to get the production out at the lowest possible cost. And I'm glad you were able to join and give us your insight today. And kind of gets us set up for the rest of the year where we can start focusing on some highly technical e-learning sessions about gas lift troubleshooting, plunger lift applications, things like that. But always great to have you on. Always great to kind of talk about the market, really the outlook. And with a few minutes we have left, wanted to see if we had any other questions coming through, any other feedback, primarily for the business. I had another question for you. Again, mainly back to the operators and the dividend space, is that that's one thing I've noticed too, is almost a lot of operators are offering dividends, and they're not barn burner great dividends, but you'll see like 3 to 5% dividend. I was looking at, you talk about a driller, H&P is up to almost 5% on a dividend for a driller, which
is amazing. Yeah.
And so does that go back to that capital discipline?
Oh yeah.
To get the money back to the shareholders? Sure,
absolutely. Yeah. They're electing basically not to, quote, reinvest in the business at this time, but to give those proceeds to their shareholders. And it's like a normal business, so companies used to trade at multiples of EBITDA, but today when you're trying to do a relative valuation, sometimes EBITDA is not the best thing to use as the driving benchmark, because this whole idea of what am I getting, what is the return on the capital I'm employing in the business, and how does that return of this business compare to the return in another business, and what are the real free cash flow dollars coming out of this business. So operating cash less capex, free cash flow. And so that's a much bigger thing, and we saw it coming last year. All I'm saying is it's really solidified itself this year, and it's not going to go away. Yeah,
that's good. And, I hope it doesn't. Don't get me wrong. It was great to play in those early growth years of $100 oil, but it's not sustainable. And, what
we got to talk about Saudi before you let these guys go.
Okay, yeah.
We need to talk about, there was an announcement last week of a delay in spending by basically Saudi, by Aramco, with regard to their planned production increase to be achieved by 25 and 26. They've dialed that way, way, way back. We've seen this year continued discipline by Saudi, by Aramco, with regard to their production, maintaining their production cuts and increasing production cuts, and they're signaling to the market. What we're hearing is that they're signaling to the market with this now planned, I won't say cancellation, but certainly delay and postponement in billions of dollars of spending out in future years. This is all kind of adding support that the production that we're seeing here domestically is going to be rewarded, and so there is some rationalization going on globally here, right? So $70, $80 oil for some people may not be a bad number. We'll see. I think, they've been defending basically an $80 Brent kind of number. That's kind of the number on Brent. They've been kind of watching. So watch that this year. Let's see what happens. It could change tomorrow.
Yeah.
But just last week, big announcement.
Okay.
Pay attention to it.
Yeah. So I'll have to watch that. But does that say that does it potentially say that they're comfortable with the production that the U.S. is putting out? Because it seems like, if the U.S. production starts to increase, that's usually when they try to drive some of those prices down to control it. Could you infer that maybe they are comfortable with the production that the U.S. is delivering right now?
I guess the obvious answer would be you could infer that, but another way I might look at it is the revenue at this price and at the production levels that they have, that they are generating today, is sufficient to meet their needs.
Okay.
Right. So why get into a situation where you go through that dip of a price war to drive us back, our production back down, and bankrupt a lot of companies that are just going to come back because it's capitalism? Why not just enjoy the price you have for a longer period of time? So they're playing the long game. There's no doubt they're playing the long game.
Yeah.
And, you've got all these other beta factors out there: Ukraine war, Middle East, what's going on with China,
Mhm.
Korea, on and on. There's a whole lot of things happening. Production coming online in Central Africa, not just offshore Africa.
Mhm.
Deals that have been struck by the Chinese to gain access. The Russian involvement in that. I was reading yesterday that there are tankers that are tanking oil back and forth in the Middle East, right around our warships that are carrying Russian oil, and we're essentially in a weird way protecting them.
Right.
It's like, so there's a whole lot of things beyond my pay grade that are going on.
I understand, and that doesn't even get into some of the currency discussions between BRICS and getting some of the Middle Eastern countries to trade oil on different currencies besides the U.S. So yeah, it gets into a whole nother topic there.
So it goes back to we need to support American production. Energy security dominoes to economic security and therefore environmental security. And we've got the ability to do it here. And by the way, if you haven't paid attention, it's a political year, it's an election year.
That's right.
So stay tuned. It's going to be a different discussion here at this table next year.
I'm looking forward to it.
Hopefully I get invited
Yeah,
back.
let's see when you join us again next year.
Sure. Anytime.
So, well, good. Before we wrap up, I have one last thing to touch on, and goes back to training in terms of future trainings for everybody. Let me jump back to that here. I think it was one of the last slides, and then we'll wrap it up. And I appreciate you joining us, Charlie.
I appreciate everybody that hung on this long.
Somebody. So, real quick, I always like to use this one. It's a great look back. It's good to get your market insight as to what's going on in the future. From here, we're going to start diving into some more technical training sessions, starting out with gas lift. We're going to get a couple guest hosts from different oil and gas operators on in April and May, give some of their insight on new product development, new applications within the artificial lift space. It's kind of center back to plunger lift, especially plunger assisted gas lift, because at this point that's being deployed in every basin.
There's a lot of changes happening in that market, right?
It really is. And so I want
Technical.
Yes, sir. And I want to talk about those technical changes, some of the application criteria, good selection guidelines for that, because you're right, it's definitely changing. And tell you the truth, places like Eagleford and Permian Delaware are driving a lot of those changes to the plunger assisted gas lift. And then of course kind of wrap up the year with, again, some capillary tubing, some downhole gauge deployments and plunger lift. So looking forward to another full year of these, and glad you're able to join us today.
Absolutely, Matt. It's a pleasure, and we appreciate what you guys do, not just with this e-learning series, but also all the technical trainings that you host around the nation during the year.
Yes,
you try to remain agnostic and stick to the facts, and let people know if you come to one of those training sessions, you're going to get the straight shot.
Yes, sir. Yeah, that's the goal.
Yeah, absolutely.
So, well, guys, thank you very much. Thanks for getting on, taking your time. Look for future trainings throughout the year, and y'all need anything else, just let us know. Thank you, guys.
Take care.